Fundamental Analysis Part 4, Book Value and Price to Book Ratio. In previous tutorials we had taken an example of Bob's store named Digital Electronics. Bob has raised $100,000 by the issue of 10,000 shares. Now, let's continue with the tutorial on book value and price to book ratio. What is equity? When a company liquidates or sells all its assets, and then clears all its current liabilities, then the amount that the company is left with is the shareholders' equity or capital. Let's see an example. Let's assume that the total assets of Bob's company is $100,000, and the liabilities of the company is $20,000. Now in case if the company sells all its assets worth $100,000 and clears all the liabilities, which is about $20,000, then Bob will be left with $80,000, which is the shareholders' equity or the capital. Next, let's see what is a book value. One can find the value of the company by subtracting value of all the assets by the value of all the liabilities. Book value represents the value of each share of the company. It is obtained by dividing the shareholders' equity or the capital by outstanding shares or total number of shares issued. Let's understand it with an example. We know that the value of the company after subtracting all the assets by liabilities is $80,000. We also know that the total number of shares issued is 10,000. Therefore the book value of the share is obtained by dividing 80,000 by 10,000, which is equal to 8 rupees per share. Here the value 8 obtained represents that, if the company is going to get liquidated in coming days, then after liquidation the worth of the company is 80,000 rupees and each share of the company is worth 8 rupees. Next, what is price to book value? Price to book value is a ratio which compares the market price of the stock with its book value. It is calculated by dividing the market price of the share by the book value per share. Here is an example. Let's assume that the current market price of the stock is 24 and we already know that the book value of each share is 8. Now we can obtain the price to book ratio by dividing the current market price of the stock by its book value. In this example, the price to book value of this company is 3, this is obtained by dividing 24, which is the current market price of the stock, by 8, which is the book value of the share. Here the value of 3 obtained represents that at the current market price if one buys the stock, then the buyer will be paying 3 times the actual value of the stock. Let's see another example of Company X. Assuming that the current market price of the stock of Company X is 75 and the book value of the stock is 50, the price to book value of the stock is 1.5, which means that if the stock is bought at the current market price, then one will be paying 1.5 times the actual value of the share. The preferred price to book value should be less than 1.75. Here we come to the end of this tutorial on book value and price to book value. Please like and subscribe. Thank you.